Welcome back. The market's doing well, but that's for the day. But over the last few days, we've been talking about the sharp slide in tech names across the board. Large names have seen cuts of 25 to 40% this year, and the mid-cap number has been even more, with stocks sliding 40 to 50%. To discuss, we're joined by Arun Jain, Chairman and Managing Director at Intellect Design Arena, and Sandip Agarwal, Research Analyst at Edelweiss, who's been tracking this space and has been quite bullish. Gentlemen, good morning. Sandip, I want to start with you. And in all fairness, in our last conversation, you did make a point that while you remain a bull, the valuations have just gone up a lot, and it's tough to to justify that. But with the recent correction, are these stocks back in your value zone?
So thanks, Anush, for taking me on the show. I will just simply say two things. One, I think valuation obviously has come under the comfort zone. But more than that, I think, the comparison which is happening right now, that the fear of US recession, Netflix number, subscriber number being low, Facebook subscriber number being low, and all those things which are used to, write a obituary of the sector, I think that is little too much, because we have seen this kind of negativity in February of 2020 also, when people said that, because of lockdowns globally, the GDPs will collapse, which happened. But did GDP collapse lead to fall in tech spends? I think no. So I think the big change which people are ignoring today is that, they are still comparing IT with last 20, 30 years of role which it played. But the role has changed dramatically. Now IT is used to generate revenue and profitability. So I think, yes, this correction is a healthy correction. But does it mean that the sector's time is over, or there is any fundamental issue? I don't think so. I think, this year will be better than last year in terms of revenue growth and profitability growth. And next year, I think, will be even better. So I am very bullish on the fundamentals. Multiples is a call of fund managers. So, they can change their priorities for a small period of time, and then when they feel it is the right time, they can again come back. But fundamentally, I don't see any pressure in the industry or the sector at all.
Yeah, tech will eat the world, but maybe only in the very short term. It's got a bit of indigestion. Good morning, gentlemen, both of you. Prashant here. Mr. Jain, if I can come to you, it's a very basic fundamental question. If the US central bank is trying to engineer a slowdown, I mean, that's a stated goal now in so many words. We are starting, I mean, for example, large US retail companies are starting to show hits. Top line growth has been healthy, but maybe margins, etc., they're getting squeezed. They'll have to squeeze someone in return, right? To kind of maintain margins and answer their shareholders. And this can go on. We're just at the beginning of that stage. Do you expect a slowdown in tech ordering at all, or you think it's not an issue?
I think, Prashant, what is the tailwind for this last 2 years, 30% growth in IT industry is not just because of the COVID or other thing. It was a backlog demand of last 50 years of the old technology, which is advanced countries are still living with. So the complexity of multiple generation of technology, which they never spent time on. It never came on the agenda, and that's created a huge backlog of the demand which digital is pushing now, because there's no alternative for large banks like Santander or Barclays or Lloyds or Deutsche Bank or US banks to adopt a digital wave which is there. Now the question is whether this Fed controls will cut on technology. I think that will be foolish on banks to cut on technology, because that's the only way to drive the higher impact. And because technology is moving from headcount technologies to impact technologies. And the more the impact is, if they want to generate more revenue, they have to build
Mr. Jain, I think we all agree that the longer term is absolutely clear. I mean, it's only going to grow, and I'm just saying that with the benefit of hindsight, your vast experience, do slowdowns in the US matter for tech spends in the near term? That's all. Go on.
Not really. Not at this point of time. It will push for the products. It will push for the platform. It push for the accelerated change. So accelerated transformation will be required. For acceleration, you need a ready-made product on a cloud, and that will be the trend which will move forward.
Okay, got that. So even if there is a recession, which there's no clarity on right now, it will have no correlation with tech spends, right? That is the consensus here. That's the concern.
That's right.
Sandeep, comment on how to approach the stocks now, because there are many retail investors that are still keeping the faith, still invested despite the 30-40% correction that the mid-cap IT stocks have seen. Do you average at lower levels? Do you wait a bit? What is the approach now?
So see, I have two parts. One, the companies which have just corrected on terms of multiple, I think those are the places where everyone should buy an average. And there are other set of companies where there's some corporate development has happened. For example, in case of LTI Mindtree, there is a integration which is there, and the integration is being engineered in an environment where attrition is very high. So that there is some risk there. At this price, I think multiples are very comfortable, but attrition can shoot up for 1 or 2 quarters. That risk is there. There are some stocks, like for example, on the ER&D side, which has gone up just simply because EPAM is struggling. I think that narrative is not right. So I would be very cautious on the ER&D name in current environment, because they are not fairly priced right still, because they are getting carried away by the fact that EPAM is struggling. So that is not the way business should be looked at. Wherever there is a corporate development, where there is a big acquisition, I would be little cautious on that, because in tech history, and integration has been very challenging. No one has been successful to do that, except for small acquisitions. But if there is no corporate development, which is the case in most of the large caps and some of the mid caps, I think those are the companies which one should buy. Means there is nothing to lose. In fact, I would say that even some of these companies, if you see US FANGs companies, last 5 years they have given away their returns of last 4-5 years. And what has changed? Their subscription has fallen because people has gone back to work. So someone who was having 5 subscriptions has gone back to 2 subscriptions, but business is better than earlier. So I don't think, I think this correction, whether it is NASDAQ or whether Indian IT, is an insane correction, and it is a very good opportunity to buy. I don't see that, we should compare Indian IT with last 10, 20, 30 years, because our role has changed from cost efficiencies and improvements to revenue generation. And that is what Mr. Jain is also mentioning. So we should definitely take his point very seriously. I 100% agree with what he's saying.
Okay, absolutely. I mean, it's purely a valuation reset that we're seeing in the stocks, right? Nothing has changed. Nothing can change in a business in just a couple of weeks, right, as we understand. But Mr. Jain, so is it safe to assume that this 20% revenue target that you had laid out for, a target of hitting $75 million plus of a quarterly run rate, is that something that you hold? And any other trends that you want to give us on how business is shaping up?
I think for us, since accelerated digital transformation is a key agenda for the large banks, and we are now have a market permission with the right kind of account names, we are working with a large product platform approach of accelerating the digital with the 4 exponential technology. And now that is a lethal combination of the products, platforms, and exponential technologies. So for your answer of design for 20%, so I did never say guidance for 20%, because in product business, last year we did 25%, though we designed for 20%. So organization is designed for 20%, but it may get us plus minus 5, depending upon some deals here and there. But on an overall traction, we are very, very bullish. Number of leads which are coming in on flow in is substantially large right now. I think we need a capacity to increase in our handling pre-sale and lead generation capacity, where we can handle them effectively.
Sandeep, I want to ask you you spoke about LTI. What else is looking very attractively priced now, according to you? I mean, in terms of ranking, 1, 2, 3, 4. I think Sandeep's frame is frozen.
Okay. Sandeep is frozen.
We can preempt his answer, right? I mean, he's been such a bull on IT that he'll say all the stocks are looking good.
No, absolutely. And of course, I wanted to also ask Sandeep, so with tech names in the US having corrected so much, there are different kinds of companies, not IT services companies. I mean, is there a way to get exposure to that part of the market as well? There are instruments, etc. So maybe we'll have Sandeep back with us in just a bit.
Yeah, we will. All right, Mr. Jain, just one question before we go back to Sandeep. You did mention that nothing has changed in the business, and that 20% growth is something that perhaps is a reality soon, the guidance that you spoke about. But just wanted to understand, you have cash on your books, about 600 crores or so. Will you be a bit judicious in your usage of this cash purely because of how challenging the macro environment has become?
That's right. Very good point. And then that was a real board in conversation. We spent almost 2 to 3 hours because of the market changing. We need to conserve the cash when we are taking a decision on dividend. So that was a very, very important point, that in this period for next 12 months to 18 months, when the markets inflation is going up, cash liquidity. So the cash is the king right now, and we need to ensure that that is managed and spent very judiciously.
Okay, Sandeep, picks in terms of Indian IT companies, rank them but in terms of high conviction and how much they've fallen. And two, with is there a way to get exposure, and what would you recommend to get exposure to US listed tech companies also, which have fallen so much, where valuations also, according to many, are very reasonable now? Go on.
So within Indian IT companies, I would say that, HCL Tech, TechM are the ones which are looking very, very attractive. The dividend yields are very high, and growth cannot go down from here. Their growth is not at all at high level or something. They will improve only. So those two names looks extremely attractive. And then you can also have, Infosys, TCS, obviously. In the mid-cap names, I think with the correction, Mindtree, LTI, Coforge are looking extremely good. And in the small cap, FirstSource and Genstar are very, very attractively priced. Within the US names, I don't know what instrument to play, but I can tell you most of the stocks which have got beaten down because of people returning to work, like Netflix or Facebook or Amazon, those are really, really good and attractive levels. I don't know if they can correct 5-10% from here. Yes, they may. But then you will make huge return over a period of 2 to 3 years, because these are very strong business model and cash generating businesses. They are not cash burning businesses. So one quarter blip here and there and supply chain issues which are hitting them and people going back to work which is hitting them should be ignored, and a long-term investor should definitely take exposure to them. These are all very, very established platforms and very good cash generating businesses.
And this is a single, you have to basically go single stocks, right? Because the ETF route, etc., is, the limit was reached and there's no revision there, right, Sandeep?
I'm not so much aware of that part.
Okay, all right. I'm sure you get asked all the time. Thanks very much, Sandeep and Arun, for joining us. It's a pleasure having both of you here with that perspective as far as IT is concerned. So the runway continues to be strong. We know that. But there is a bit of a blip, which of course is occurring. It happens from time to time. Some of the froth being corrected after the sharp run-ups that these stocks had seen. The market is up about 344 odd points or so at this stage.